banks are collapsing everywhere like dominoes.
I mean, everyone's talking about it.
Everyone's talking about it. Yeah, so this is actually, I think they were showing the second largest bank collapse in U.S. history. And man, it's crazy to think that like the 2008 recession, it seems weird to say 2008 and thinking that it was 15 years ago.
Yeah.
Like 2008 seems like it was like 5 years ago, but it's been 15 years, and that of course was the the big recession we had last. So this is kind of like I don't want to say the next. I don't want to say we're at the recession right now, but this is kind of the biggest financial flop we've had since that time.
Well, one also because of the inflation, interest rates going up like skyrocket too, right?
Skyrocketed. Yeah, it's just been crazy. I think this is the time where we've noticed every single thing we learned in micro and macroeconomics, every single principle is being talked about right now, whether it's the hyperinflation, interest rates being all-time low, interest rate being an all-time high, and everything in between, manipulating the market to keep interest rates low, manipulating the market to keep interest rates high, trying to deflate, everything like that. So I think this is definitely a crazy time. Actually, I remember in '08, I don't know if you ever did it, but it was like 2 or 3 in the morning. And you could like watch, there was like a channel that was literally just about like Florida properties, and they were literally like $1 for like acres.
Oh man.
They were in the middle of nowhere, but they were literally like $1, $10. I remember Detroit had the same thing, like $5,000, $10,000.
That's crazy. Yeah.
And
can you imagine what Texas was at that time then?
yeah, I know. I know. Are you?
What were you saying?
I was saying you're going to Texas?
I mean, it's still nice. I keep getting these feeds about on Instagram saying, because I keep looking at those properties.
That's all I do. I watch YouTube videos all day about Texas properties.
For $550, you get a whole pool, swimming pool, tennis court, ball court, inside. Was it a movie theater?
Yeah.
All for $550 US.
And you're still here.
I'm still in Milton. I'm not here on Milton.
No.
It's just Canada itself.
Too much. Yeah. But yeah, so Silicon Valley Bank, that's kind of the newest one. They were at the time 16th biggest bank in the US, and now they've been just shut down. It's kind of, as the days goes on, more things will happen. So, but as of right now, it's been shut down. FDIC came in, shut it all down. And FDIC is basically the Federal Deposit Insurance Corporation. They're the ones that if your bank is not FDIC insured, run away, because if the money's gone, then your money's gone as well. So make sure your stuff's FDIC insured. But another bank was also the Silvergate Bank. They were shut down as well. But I think the difference between those two banks, people hear the word banks, but they don't understand that there's different types of banks that are happening.
Right.
Everyone kind of thinks of the usual banks like the TDs, the IBCs, all those. But those are, exactly. But those are a little bit different than these type of Silvergate and Silicon Valley banks. Silicon Valley especially, I mean, it's in the name, Silicon Valley. They were focusing more on more of a niche target. They were obviously focusing more on like tech firms and that type of stuff. People who were looking for new venture capital.
Intangible assets.
Yeah, exactly.
Main importantly,
Crypto, yeah, all those things. So that's where Silicon Valley Bank came in. So yeah, they did collapse, and one of the big reasons, like you just mentioned, crypto was obviously crypto collapse, which means they collapse and everything along with it. So yeah, you hear the word bank and you start freaking out, but it's a little bit different than your usual bank. And even our usual bank, whether it's TD or CIBC or BMO, like you said, I know you have more than 250,000, but yeah, just keep in mind that anyone who has 250,000 in the bank, if they do go under or whatever, the money's gone, you will get your money back, but only up to 250,000.
I mean, who should be keeping that 250 though? Because that's not smart to keep in the bank.
Bro, when you got it, you got it. Don't tell me where to keep my money.
I would say distribute that potatoes in a basket, man.
Yeah. So, but both these two banks really focus on crypto. Those were kind of the things. And that's kind of the fight that's happening right now. The five, especially in Canada, there's the 5 big banks. They're messing around with crypto. They're not really messing around with crypto. Yeah. Whereas these two banks kind of actually took advantage of that. They did notice that a lot of banks were not messing with crypto, so they said, well, why don't we come in and kind of do that? With crypto, yeah, sorry, go ahead.
Because they have the upper hand, right? There's something that unique about them that the typical banks weren't willing to do. Because there is a high risk, right?
There is a high risk, and honestly, with the shift, when you're the big dog and you're the lead, no one wants to ever shift, right?
Exactly.
That could lead to other companies coming in, and honestly, all these banks and stuff, they're all dinosaurs. They all do stuff. Like, so honestly, I was shocked in America. It took them forever to get freaking Apple Pay and like all that stuff, like Tap.
Yeah.
Like, I remember we had tap, and I went to America. I used to go to America a lot, and then they looked at me like I was a freaking alien that had tap.
Really?
Yeah.
Oh, wow.
So I think America's just slacking on that, um, but yeah, basically the banks didn't really want to mess with crypto. So again, these two kind of banks came in and did that. And we talked about it a bit in the previous episode. So go back to, I think it was our first episode, but FTX and all that scandal. So obviously when they crashed, a lot of companies fell like dominoes after that as well.
Right.
And this is one of them. They were just collabing on things and working together. And when FTX collapsed, a lot of people who did work with them obviously wanted to stay as far away from them as possible. They were exchanging crypto with fiat currencies. And basically what they were doing is they were allowing people to use Bitcoin as collateral for loans. And then of course, if Bitcoin's not worth anything, your loan is kind of useless now as well. So there was a lot of going on with that.
But I know a lot of people would probably ask me, what's a fiat currency though? Because I'm getting a car right now off the bat.
So what is a fiat currency?
That's what I'm asking you, man.
Okay, so fiat currency, basically it's a currency that's not backed by any commodity, which we'll talk about a bit later. Meaning a lot of currency used to be tied to gold reserves and everything like that, but now people are like, yeah, who cares? So that's kind of what a fiat currency is. That is basically not tied to any physical commodity, meaning the value. You can have $1 million of fiat currency, but maybe there's nothing to tie to it. That kind of thing. So usually money was tied to how much gold we had, which kind of made sense that in case anything happens, we can pay you in gold. But now it's just all over the place.
So like digital based, essentially.
Yeah, digital based, made up, whatever you want to call it.
Yeah.
But yeah, they of course went on liquidation mode. They started selling off all their assets. Of course, so when you go bankrupt, you start going crazy. You start selling everything off. And like I said, FDIC will only cover up to $250,000. So for normal people like myself, that's okay. But for
CPO.
Chill. Oh yeah, by the way, congrats on the. Finally,
it.
I remember at the first episode you said candidate like a.
You know what? Cut that. We're gonna go back
and you talk and you put it into existence. But yeah, anyway, so people like you, for example, only your first 250 is gonna be covered. All that other you got chilling, that's not gonna be covered.
Remember the tax guys.
So what people don't realize is for normal people, yeah, maybe 250 is not that much, but with these big companies who have like millions and millions of sitting in the bank. Right, you do need a certain amount of liquid cash as well in case you want to buy something. You know, companies are buying assets or other companies as well. So the fact that only 250,000 will be covered is actually kind of alarming for a lot of companies.
Yeah.
A lot of companies will be impacted by that, and unfortunately, obviously, the employees that work for that company will always be the first to
chuck out.
Exactly. So what happens is then the banks start selling off their assets, and they start. It's not like it's only 250 and you're done, that if you have more than 250, forget about it. It's just that when the company sells their stuff, then they start paying you back. So hopefully you start seeing more of the money back. But the first 250 for sure, you don't even have to worry about it. The other ones, you're kind of worried, okay, hopefully they sell this, hopefully they sell that. It's a lot of court work that happens, a lot of lawyer talk, but yeah.
I mean, it's a high risk though, eh? Keeping that much money.
Yeah, it's true. That's why a lot of the smart companies, they'll either have it with like humongous banks or they'll spread out their, and I think that's what we talk about, diversification. They spread out their money a lot throughout different banks so that even if one bank does collapse, like it's cool. We got other places that, we're good.
Yeah.
But yeah, then Silicon Valley Bank collapsed as well. And of course, this is the theme of the podcast this year is that the interest rates have been going all the way up. And just like us, it's basically our jobs, everyone's job, and banks have the same job to figure out how to mitigate that risk, manage that risk with interest rates going up. And so like we talked about Silicon Valley, they of course deal with Silicon Valley startups and venture capitalists. Everyone reads on the news that this random companies worth billions and billions of dollars. Well, that's how Silicon Valley Bank comes in. They connect and deal with like the big companies. There's Sequoia Capital, there's Spark Capital, there's other capital like the Illuminati basically of Silicon Valley, and they're dealing with billions and trillions of dollars. And so that's where they're kind of like the middleman. They deal with the companies and the capital firms, and they also deal with like smaller people who, smaller companies will work with Silicon Valley Bank so that it's kind of like just getting their foot in the door and getting introduced to, the capital firms and stuff like that. So that's why it tended to be a lot more smaller companies that were impacted by this one.
All small companies though? You don't think like big companies would be a little bit ahead?
Yeah, no. I'm
Yeah,
saying
yeah.
specifically for this bank. A lot of
Right.
companies will definitely be. I mean that a lot of smaller companies had money in this bank.
Yeah.
Yeah.
Well, they depended on it solely.
Yeah,
right?
exactly. I think the biggest one was Roku actually.
Roku. Right.
Roku had, I think at the time they had $500 million chilling in the bank.
Oh wow.
Oh,
they're not getting that back.
No. And at that time, on the 500 million, they were making I think $20 million of interest on that stuff.
Wow.
So, but yeah, like you said, they're not getting the money back.
That's horrifying. Not just people getting laid off, but
Yeah.
the company itself.
Yeah, exactly. So, actually, Silicon Valley Bank is a little bit interesting. It's a good study to, especially if you're trying to get into not just banking or anything like that, but starting a company. They were able to find a niche market that, again, a lot of people think about banks as commercial loans, mortgages, car loans, that type of stuff. But they noticed that there were smaller companies that also needed capital and stuff, that especially in tech land, and a lot of people were just throwing them to the side and didn't really worry about them, especially recently where everybody's hearing about billion-dollar valuations, that people were only wanting to deal with essentially billion-dollar companies. So there were a lot of normal companies, and this is where SVB came in. They started being the middlemen. For all my blacklisters out there, they were on their Raven Reddington and just connecting the smaller companies with the bigger capital firms, the investment firms, and this kind of allowed all these billions of dollars to flow between the two. And of course, the banks and the middlemen, so they eat off both sides. So,
right. When they always recouping everybody else cost it.
Pretty much, yeah. That's the fun of banks. Banks play with your money and then keep the money.
I mean, it's like they're playing with you, but they're actually playing it for themselves.
Yeah, obviously. That's what I think people, even with banking, how that works is that the $1,000 or $10,000, whatever money you have chilling in your bank, that money is not actually there.
Yeah.
It's already loaned out right away.
Yeah.
And they keep
people, right?
It's already loaned out. They only keep a little bit on. It's called reserves. They have to keep I think 10 to 20%. They keep on reserves, and then the rest is already loaned out as soon as you threw it in there.
So as long as they have that much people.
Yeah, that's the thing. As more people come in, that allows them to give bigger loans, which allows them to eat more off interest and everything like that. It's just a network that they build.
But what happens when everybody starts withdrawing, which start panicking?
Which is what happened with SVB essentially. That people started panicking. Crypto's down, everything is down, and so then they went and started withdrawing the money. And of course, no one withdraws like $5, $10. They're withdrawing everything, and that's what happens essentially. That they're not able to pay it back anymore.
Exactly.
And that's the crazy thing. You walk into a bank and you want your money and they won't give it to you.
They won't. No.
They won't give it to you.
It's funny because my aunt was talking about this TFSA.
Yeah.
You can put money whenever you want, whatever time, whatever day.
Yeah.
But when you want the money back, you have to
Never.
call them.
Never.
Get on a phone call.
Yeah.
Wait for that line just to get your money back.
And you have to like beg to
beg. Yeah. And they'd be like, "No, sir, you cannot withdraw $1,000. You're gonna have to wait for a bit." I'm like, "This is my money."
I know.
And I can put whatever amount I want.
No.
That's the funny part.
Yeah. I remember I took out a little bit more than 1,000 at one time.
Yeah.
And I had to like prove like my employment and everything. I was like, "Yo, this is crazy."
Yeah.
It's like I just wanted to do a money phone and I just want to take an Instagram picture, but no, I had to go through all this like. That's when I learned that they just have a few real $100 bills and then the rest are fake in the middle. That's where.
Monopoly there.
Yeah. So. But yeah, that's kind of sucky. But yeah, basically SVP, I think overall throughout their years, they collected $200 billion in deposits. And yeah, we just mentioned that the smart banks or banks in general, forget smart banks, is how quickly they can start making money off that money. So the usual banks we talked about, the CIBC and stuff like that, they make money off mortgages, commercial loans, all that kind of stuff. But no one was really running. So obviously no one's going to Silicon Valley Bank for the mortgages and stuff like that. So they had to be a little bit more, I don't want to say creative, but they had to think a little bit differently than other banks to figure out how they can obviously make money. And so they would put their loans into obviously other ventures, but more government treasuries and stuff like that. Government treasuries are always, especially Canadian and US, are always safe. And obviously with business, it's either, if you're safe, that means the reward is, high risk, high reward. So with them, their risk was not there. So therefore the reward was nothing crazy either. So they started buying up all these bonds and everything like that, especially in the during COVID at the beginning when it was, interest rates were really low. So bond rates were really low. They were buying them up, but as interest rates started going up, everybody, but mostly SVB, would have to pay the higher interest rates to the firms to keep their deposits with them, or else the firms would just take their money and then go somewhere else and get the higher interest rate, right? And so that's kind of what happened.